Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast, which is a podcast that started as an excuse for us to start contacting smart people in the world of finance without sounding weird. And look where it got us. Now, I hate to start an episode by saying that we have a special guest because I don't want any of our previous guests to think that we don't think they're special. However, this one is truly special, as I had the great pleasure and honor to speak to none other than Howard Marks, the co-founder and co-chairman of Oaktree Capital, and arguably one of the greatest minds in finance of all time. We cover a lot of ground in this interview. Howard starts by telling the fascinating story of what it was like in 2007 for Oaktree to raise its largest fund ever at the time, and how Oaktree reacted to the global financial crisis by investing $430 million a week on average for 16 weeks after the fall of Lehman Brothers in September of 2008. We also talk about the importance of being contrarian, the culture of Oaktree, index investing, technology. We finally get into some of the great principles Howard has shared with us through his books and letters over the years, and of course, much more. I was extremely nervous for this one, and it might show during the interview, so I apologize for that. I had prepared for over 3 weeks. I read all his books, most of his letters, wrote down notes, the whole 9 yards, and as I was speaking to him, I accidentally called him Mark. Not once, but twice. So Howard, I apologize for that. I'm just a big fan and was nervous. So the good thing is that we can edit these things out. So if you learned a thing or two from this episode, I would really appreciate it if you could leave us a review on Apple Podcasts or wherever platform you are listening to this episode from. So without further ado, please enjoy my conversation with Howard Marks. Hello, Howard. Thank you very much for being here and agreeing to speak to us at the Wall Street Lab. It's a true honor to have you on. As I'm sure everyone knows who you are, I won't ask you about your background as I usually do, but I would like to go back to 2007 when you were raising a fund for Oaktree. I've heard you tell the story before, so can you please share that with us?
Sure. Well, when you tell these stories, since life is cyclical and you want to give a whole picture, it's hard to figure out where to start telling the story. But suffice it to say that in 2001 and 2002, we raised our biggest fund to date, and that was our funds 4 and 4B with a total capital of $3.5 billion. They ran into the meltdown of the telecoms and the scandal companies in 2002, and as a consequence, we're able to buy bonds extremely cheaply and had very, very high rates of return. But those bonds sprung back in price in 2003, and there wasn't too much to do in the distressed debt world. We turned instead mostly to selling assets rather than buying more, and we shrunk the capital of our funds. So $3.5 billion in 2001-02. We followed that with the fund in 2004 of $1.2 billion, so only a third as much. And then in 2005, $1.8 billion, no fund in 2006. By the beginning of 2007, we began to believe that there was an opportunity coming, stemming from the excesses that had been perpetrated in the financial world in the immediately preceding years. And so we sent out a letter to our clients on the first day of 2007, saying we would like to have $3 billion for our next fund, which happened to be called Fund 7. And within a month, we had commitments of $8 billion. Of course, there was no distress in the world in those days. So we got back to the limited partners and we said, we just can't use $8 billion. So we'd like to get $3.5 billion and close Fund 7 with $3.5 billion. And we would like to have the balance of your commitment for a standby fund, Fund 7B, which we will only activate if there is a great opportunity. And we closed Fund 7 at 3.5. We had the first closing for Fund 7B in March of 2007, and then We went on to market Fund 7B for a year, and by the end of that year, March of '08, we had the final closing, and the fund stood at $11 billion. Now, remember that our biggest prior fund had been $3.5 billion. Mm-hmm. So it was a multiple of that. And the truth is that there weren't great buying opportunities from the first close in March of '07 until June of '08. Most of the distress opportunities, most of the stress was related to subprime mortgages and other financial instruments. Mm-hmm. And as a consequence, most of the available distressed debt related to financial institutions. And of course, we wouldn't want a fund to become too heavily weighted to one industry. Mm-hmm. So outside of financial institutions, there weren't great things to buy. And we didn't do any buying in Fund 7B until June of '08, at which point we had fully invested the capital of 7, so we started to gradually invest the capital of 7B. I should add that one of the reasons we were able to attract so much capital for 7B is that we said to people, number one, we're not going to invest until an opportunity arises. Number two, we're not going to charge any fees until we begin to invest. So most people who trusted us to keep our word in those regards were willing to give us money, you might say on the come, to prepare for an opportunity. So we began to gradually invest in June '08. By September 15th of '08, which was the day Lehman declared bankruptcy, the fund was 12% invested. And by the end of '08, which was 15 weeks later, it was 70% invested, which is to say that over the final 15 weeks of '08, we invested 58% of an $11 billion fund, or $6.5 billion, or about $430 million a week on average. Wow. And, you know, the truth of the matter is all you had to do was invest money in the fourth quarter of '08. The Lehman bankruptcy and a few other developments precipitated a real meltdown. People were literally throwing out the baby with the bathwater, and all you had to do was spend money. You didn't have to be careful or conservative or risk controlled or disciplined or patient, and you didn't even have to be that selective. And we were convinced, for a variety of reasons, that spending money was a good thing in that environment. And of course, it worked out very well. And if you had money for distressed debt, but you hesitated to invest in the fourth quarter of '08, the point is that at the end of '08, most of the bad environmental conditions receded. The hedge funds that were having redemption notices were able to satisfy them. Most of the overlevered entities were liquidated. And so there weren't many opportunities to invest in early '09. Prices continued to drift down. And if you looked at the price chart, you may say, well, there would continue to be buying opportunities. But the truth is there wasn't much for sale. Mm-hmm. The large quantities for sale had come from the panic of the fourth quarter of '08, and that was over. Mm-hmm. So it was a very interesting cyclical phenomenon that I think we were able to get on the right side of.
It seems to me that great markets for fundraising tend to be bad markets for investing just because
Absolutely. We always say it's one of the secrets of the investment business that the best thing to raise money for is the hardest thing to raise money for because it's under a cloud. And the easiest thing to raise money for is the worst thing to raise money for because it's the thing that everybody wants.
That's very interesting.
And that's just an example of the contrarian mindset, which I think is absolutely essential if you're going to be a good investor.
Absolutely. And we'll get into that later about your idea of being contrarian. So I'm assuming that there are other distressed credit managers that knew what you knew, but did not have the guts or the conviction to put so much capital to work at such a rate as Oaktree did and take advantage of that passing opportunity.
Nobody else had similar amounts of money. You know, we've always, for decades, we've been the biggest in the distressed debt business. But other people who had smaller funds, I don't think were willing to invest a comparable percentage. I don't think many distressed debt funds invested 58% of their capital in the fourth quarter of '08. In areas like distressed debt, there's a saying about catching a falling knife. And many people, when prices are collapsing and cascading downward, many people say, well, we're not going to try to catch a falling knife. We're going to wait till the knife stops falling, the dust settles, the uncertainty is resolved, and then we'll spend money. But of course, the great bargains come from buying while the knife is falling and while everybody else is petrified. And so I think many people did hold back. I don't think there were many big buyers other than us and maybe that guy in Omaha in the fourth quarter of 2008.
And what do you attribute that to? Is it your process that is better than others, or is it your ability to control your psychology? What is it about?
Well, I think the ability to control emotion is extremely important. And the point is that prices collapse because people are petrified. But by definition, if you're petrified, you can't buy. So in order to buy when prices are collapsing, by definition, you have to have control over your emotions and not be petrified. And again, that's another example of contrarianism. Mm-hmm. So I think that emotional control is extremely important. Another thing is, of course, I think we're the oldest or just about the oldest player in the distressed debt business, or the oldest significant player. So I think we have the most experience. And Bruce Karsh, who runs these funds and has done so since the first day in 88, is still doing it, along with now he shares the responsibility with some colleagues, but he was still the portfolio manager in 2008, 20 years later. He had 20 years experience. Nobody else had 20 years experience. Mm. And so I think that's extremely important. And part of having emotional control, thirdly, I'll mention that part of having emotional control is in order to do a great job as an investor, while you want to do research which convinces you that you're right in your actions, it's important, I would say indispensable, to not be afraid of making a mistake. Mm-hmm. You have to be willing to be wrong. And in particular, the people who won't catch a falling knife say, well, it may not have hit bottom yet. I don't want to buy until it hits bottom. We're happy to buy before it hits bottom. And all the way down as it gets cheaper and cheaper and cheaper. And to spend money at the bottom, of course, which is the goal, and even to spend money on the way up. You can't, especially if you manage large amounts of money, you can't say, no, we're not going to buy before it hits bottom. First of all, you'll never know when you're at the bottom until the bottom has been passed. But secondly, there just isn't enough of an opportunity at the bottom. You have to buy over time. And we're not afraid to buy and see things go lower, in which case we'll buy more. So I would say those three things contributed. And the other thing, of course, why have we been successful? And I think the answer is we have terrific people. Mm-hmm. And Bruce is a fabulous investor who embodies all the values that I described. And the colleagues that he has co-managing the funds at this time. Now, these are what I call the kids, the newcomers to Oaktree. They probably average only about 17 years of experience with us, and they're equally fabulous. Mm. Those are the essential ingredients for success.
If I did my research correctly, you have averaged an 18.8% gross IRR in your longest standing fund since October 1988, which is higher than the S&P 500, that's 10%, and the MSCI World is 4.7%. So you've proven, of course...
Let me just interject. I think that figure is the return. I could be wrong, but I think it's the return for all of our closed-end funds.
Okay.
I think the return for just the distressed debt funds has been higher than that.
Okay. So what I was getting at is, we, in my day job as an investor for a family office, we see a lot of very talented investors out there, but we don't see investors that have been doing this for over 30 years as you do. It seems like there is more than just smarts and talent to make that work. Can you talk about the culture within Oaktree, or what was it the aspect of working there that made your team of the more veteran and the kids, as you mentioned, want to work there for that long?
I think that the answer is that we've made it a very intentional effort to have an attractive culture and to make Oaktree an attractive place to work. We don't have a dog-eat-dog culture. I think everybody's very respectful of each other. It's not very hierarchical. We try to control the ego and the testosterone, and we try to have only nice people that you would want to work for and to have a pleasant environment. Now, it doesn't hurt that we've been very successful, and people like to be associated with success. But, we stress fair sharing of the results so people don't have to leave Oaktree to get theirs. You know what I'm saying? They can stay and do very well. In a lot of organizations, if you're not at the top, you say, well, I have to start my own firm and where I will be at the top in order to have a good return. Oaktree has been so successful, and the funds are so large that even people one or two levels down can have a small percentage of the fees from a very large fund and do very well. They don't have to go out and start their own firm where they would have a large percentage of the fees from a smaller fund. I think we try to hire people for whom maximizing their income in the short run is not everything, which is very important. We don't want people for whom money is everything. Mm. And so, if you put together those features, nice people, pleasant environment, then I think you can keep people for a long time. And our turnover has been extremely low. And only, of course, by having low turnover can you develop the amount of experience that we have.
I want to get into some of your writing, which you do extensively through your memos. And for those listeners who haven't read them, I highly recommend them. I think everyone in our team reads them when they come out. We receive an email and they're great. So I want to pick a few quotes from you and ask for your opinion. The first one is, you say, experience is what you got when you didn't get what you wanted. Can you elaborate on that?
Well, you learn a great deal in our business and in most walks of life from your disappointments. And you don't learn much from your successes. Think about an investor. A guy makes an investment, or a gal, and it works out well. What do you learn? Here's what you learn. It's easy. I can do it. I don't have to worry about failure. I don't have to worry about risk. I can do it bigger, that is, with more capital. And I'm so smart that I can branch out into other fields and enjoy the same level of success. And all of those lessons are very bad lessons. You should not lose your humility, because this is a challenging field. And you should not conclude that it's easy. You should not conclude that it's a cinch. You should not forget to worry about risk. You should not branch out into many other arenas, and you should not take on too much capital. Mm-hmm. So I think that the most important lessons, the most important experience comes with unsuccess, not success.
In your discussion about market efficiency and the most important thing, you speak about the fact that one of the greatest ramifications of the Chicago theory has been the development of passive investment vehicles known as index funds. And these types of vehicles have become a lot larger than I think was envisioned and expected today. What do you think is the effect of index investing in the overall market behavior today?
Well, I graduated from University of Chicago, right, M.B.A, 50 years ago this summer. And so when I went there in the late 60s, what did they teach me? They taught me that the average investor, certainly the average mutual fund, performs behind the S&P before fees and further behind the S&P after fees. So somebody had the bright idea among the professors, why don't you just buy a little bit of every stock in the index? Now, nobody talked about indexation or index funds in 1968, but that is what developed. Mm-hmm. And of course, now passive investing and index funds are said, for example, to manage about 40% of the equity capital in U.S. mutual funds. Why? Why have index funds grown like that? And the answer is not that their performance has been so good. Because remember, the index fund only does average. Mm-hmm. The reason they grew is that the active investors were so bad. They didn't beat the index. In many cases, they didn't live up to it. And they charged high fees in the process. And one thing you and I both know is that if you have an inferior product, you shouldn't be able to get a high price for it. Mm-hmm. So that's what has happened. And the index investor has done better than the active investor at a much lower cost. Mm. Now, some of these phenomena may be temporary. There may be a point where we reach equilibrium where, there may be some times when active does better than passive. There just hasn't been in quite a while. And to date, in part, the prophecy has been self-fulfilling. Mm. But anyway, now we're in a world where between indexation and passive investing and systematic or algorithmic investing, which is the next step on the evolutionary chain, a lot of money is being run without conscious fundamental decision making. Now, it stands to reason, only logically, it can't be proved, and there's no experience, but stands to reason when we reach a certain quantum of passive investing, and very, very few people are making fundamental assessments anymore, then it seems to me that the profitability of fundamental investing should return. In other words, the efficient market hypothesis says it's very hard to beat the market when millions of people have the same information, are working hard, are highly motivated, and doing the same thing as you. But if a big percentage of those people drop out and stop doing research and stop making fundamental assessments, maybe the profitability of that activity will make a comeback. That's all. But the answer so far is not yet.
But yet you talk a lot about psychology and the role of psychology in investing. And now that you have so much investing that is done on a rules-based or systematic, done by a machine that does not have those emotional pitfalls that we all do.
Yes.
Does that change the game in any way, in your view?
Well, I think it should change the game. If you think about a computer, now let's say, so we start with passive and index, and then we move to systematic and algorithmic. And then the next step, by the way, I wrote a memo maybe a year or two ago called Investing Without People, because that's what we're talking about. So let's say you get to the point, the third stage, where a lot of investing is being done by AI on the basis of machine learning. And machines study all of the investing history and they figure out how to make good decisions. So let's figure that's where we are. What can a computer do? That's the question. What are its strengths? And the answer to me, I'd love to know if I'm wrong, but the answer to me is they can handle a huge amount of information. They can do it very fast. They can do it without making any computational errors. And according to your question, they can do it without making any emotional errors. So they're not going to get excited when things get expensive and buy more, and they're not going to get depressed when things get too cheap and sell. And those are great advantages. And merely eliminating the emotional error will be a great advantage. However, the question is, will anybody be able to beat the machine? And so I believe that the machine will be able to do as good a job or better than, I don't know, who knows, 95% of all people can do. I hope, for my own sake, that there will still be a place for a few percentage of the people who can do a better job. And I think what the computer will not be able to do is make future-oriented, qualitative decisions. For example, can a computer sit down with somebody, talk to him for a couple hours, and figure out whether he's Steve Jobs? Can a computer scan 5 Silicon Valley business plans and figure out which one is Amazon? Or in our own case, can a computer look at a distressed situation and figure out how all the different creditor classes are going to do in the restructuring? And, I hope that there will still be qualitative decisions, future-oriented decisions that some people will be able to do an exceptional job at. And of course, we'd like to be one of those people.
Great. And I think it was, if not the first, I think it was your second memo that you wrote in 1991. You described the mood swings of the securities markets resemble the movement of a pendulum. And I love that concept. And I'd love to ask you to describe that to the audience.
That was, as you say, it was 91. It was the second memo. It's kind of, that was 30 years ago almost, but it kind of crystallized a lot of what I had been thinking about up to that point. And the point is that people, not being computers, we were talking about what computers can do. And one of the things we said is they won't make emotional errors. People make emotional errors. And they swing. And they swing from between fear and greed, and between pessimistic and optimistic, and between skepticism and belief, etc., between risk averse and risk tolerant. And they swing Number one, because of what's going on in the environment. And number two, because of what their friends are doing, what they see people doing around them. And there's a herd behavior, so that when a lot of people get scared, it tends to make other people get scared. Now, what you want to do is you want to do the opposite. You want to be an active buyer when everybody else is terrified and not buying. And you want to be a seller, maybe, when everybody else is euphoric and buying despite the prevalence of high prices. So obviously, one of the most important ingredients is to understand what's going on around you. Buffett says, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. When other people are acting imprudently and buying in an aggressive way, despite high prices and risks, we should be extremely careful, and vice versa. And that makes total sense to me. Mm-hmm. Again, the word I used before, contrarian, trying to do the opposite of mm-hmm. what most people do, the opposite of the herd. Mm-hmm. And so I think understanding the swing of the pendulum or the ups and downs of the cycle is essential. And that's why I wrote a book last year mm-hmm. called Mastering the Market Cycle, mm-hmm. because it's only by understanding the swings and where we are in the swings that you can get the odds on your side. Mm-hmm. It's something we believe in very strongly.
Mm. You talk about contrarianism and being skeptical, but you also talk about pessimism not being the same thing, right?
Yeah. Well, I think that I wrote a memo in the financial crisis, and I think it was October of 2008. No, I'm sure it was, called The Limits to Negativism, because I was trying to get some clients to move forward in that climate and invest more and take more risk because the bargains were so pronounced, and they just wouldn't do it. They couldn't think of anything that ever could go right. No matter what worries I offered to discuss, they always thought things could be worse. Mm-hmm. So I wrote this memo, The Limits to Negativism. And in that memo, I said that most people associate investing, high-quality investing, with skepticism. That is to say, you don't necessarily believe everything you're told. And if things appear to be going well, you think about the chance they'll stop. And if things appear to be down and out and going poorly, you tend to think about whether that's really true. So, we all say that it's important to be skeptical. And a great example is that if somebody comes into your office and says, I've been managing money for 30 years. I've made 10% a year for 30 years. I've never had a down month. Your job is to say, that's too good to be true, Mr. Madoff. And too good to be true are some of the most important words in the world. And we all grew up learning that sometimes we have to say too good to be true. But in the October of 2008, when nobody could think of anything that could ever go right, what I said was that skepticism is not synonymous with pessimism. Sometimes skepticism requires optimism. Mm-hmm. Sometimes when everybody around you is frozen by fear and pessimism, your job is to say, no, that's too bad to be true. You're overlooking the possibility of gains and of recovery and of repair. And of course, it was because we considered the possibility of recovery and we concluded that everybody around us was being too pessimistic that we were skeptical of the consensus pessimism, and we were able to invest the amount of money that I described before. And I was talking to a reporter for one of the world's leading newspapers, and he said to me, "Well, what are you doing here in October of 2008?" I said, "We're buying." He says to me, "You are?" Like it was an unbelievable possibility, but that's what you have to do when absolutely nobody else is willing to buy and you've seen prices collapse. Then you have to say, no, these are the conditions in which we must move ahead. We have to get our emotions under control. We have to be willing to catch a falling knife. We have to be willing to make a mistake, but things are cheap and it's our job to buy.
You quote David Swenson in your book, when he talks about investment success requiring sticking to positions that are uncomfortable. So that uncomfortable feeling should be probably there at all investment decisions that you make as a prerequisite for a good buy or sell, depending on what you're doing, if you're long or short. Do you watch for that feeling of lack of comfort when you're making those?
I think you have to understand what you're doing and understand what's going on around you. Now, the Swenson quote actually says that what's required is uncomfortably idiosyncratic decisions. And so what does that mean? I just got back from a week in Latin America last week, and I was going around explaining to people you have to be idiosyncratico e incómodo, idiosyncratic and uncomfortable. And what does it mean? Obviously, if you think the same as everybody else and have the same emotional reactions as everybody else, and as a consequence, you behave the same as everybody else, guess what? You're going to perform the same as everybody else. And usually that's not very good. So in order to be, my goal, our goal at Oaktree is to be an exceptional investor. Clearly, to be an exceptional investor, you have to think, feel, and act differently from others. So that's what Swenson means when he says that your behavior, your positions have to be idiosyncratic. That is to say, different from others. Mm-hmm. And by the way, being idiosyncratic is not enough, because if you're idiosyncratic and wrong, then you'll perform different from the herd. You'll be below average. What's required is to be different from the herd and right. That's how you do above average. But anyway, the goal is to be different from the herd and right. But then there's that word uncomfortable, because if you're in a market and everybody's buying and the market's going up every day, and you say, you know what, I think the prices are too high, I think that the emotion is too positive, I think people are making a mistake based on greed and optimism, I'm going to sell. So everybody else is buying, you're selling. Their buying is still making the market go up. So you have behaved idiosyncratically, and guess what? You feel like crap, because it's not easy to hold an idiosyncratic position, which usually most of the time is wrong. Swenson says that investment success requires sticking with positions made uncomfortable by their variance with popular opinion. It's very hard to do something which is different from what everybody else is doing and feel totally sanguine about it, because you are at variance with popular opinion. But clearly, it is what you have to do in order to have exceptional results.
Very, very interesting. Touching on that point,
By the way, if you're idiosyncratic and wrong, then pretty soon you'll have to find another job.
That's an interesting point, because people who may not be in the investment industry, or maybe they invest their own money, may feel encouraged by this and say, okay, well, if people are buying stocks, I should buy, let's say people are buying U.S. stocks, I should not buy that. I should find another place to do it.
Right.
And you mentioned an article written by Charles Ellis titled The Loser's Game, which I think is brilliant and talks about the difference between professional tennis players and amateur tennis players. Can you elaborate on that?
Yeah. Well, professional tennis players play a winner's game. In order to win a tennis match against another pro, you have to hit winners. You have to hit shots he can't return. If you don't hit winners, then he'll hit a winner and you'll be unable to return it and you'll lose the match. So for Federer to beat Nadal, he has to hit winners. In amateur tennis, we don't have that level of skill. I'm an amateur tennis player, but I can't hit that many winners. So how do I win? I avoid hitting losers. I keep it in play. I hit it back, and 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 I hit it back. And if I can hit it back 10 times, not great shots, just keep it in play, eventually my opponent will either hit it off the court or into the net, and I'll win the point, not by having hit a winner, but by having avoided hitting losers. And in many ways, I thought that this was comparable, and Charlie Ellis thought that this was comparable to investing, because in investing, it's hard to hit winners consistently. And there's all the things you don't know, and there's the unpredictability of life, and there is randomness. And the professional tennis player can consistently hit winners because he's so skillful that he has everything under control. But in investing, There are so many things that we don't control that we can't consistently hit winners. And I have always felt that it was very desirable to avoid hitting losers in investing.
Mm-hmm.
And Oaktree's motto is, if we avoid the losers, the winners take care of themselves. Our fields are risk fields. We're not investing in treasuries or gilt-edge equities. We're investing in risk assets. And if we can consistently invest in risk assets and have a portfolio, for example, without any losers, then what does it mean? That means that our positions will be okay or good or very good or excellent, but with no terrible ones to pull the average down. So we'll do well. We believe that in trying to be exceptional, it's probably more dependably accomplished by lopping off the unpleasant left-hand tail of the probability distribution than by trying to consistently get into the profitable right-hand tail.
Mm-hmm. Oh, that's great. I wanted to ask you about your concept of taking the temperature of the market. Yes. Well, first, let's start with what's your view on investment forecasting? And I think that will lead to your concept of taking the temperature of the market.
Well, I don't believe in macro forecasting. I haven't met many people who are consistently successful at macro forecasting. And Oaktree, in its investment philosophy, specifically eschews macro forecasting and eschews making investments based on macro forecasts. And again, we talked about excellence in investing, superior investing. The goal is to be superior as a professional. If we can be average, but as the indexation movement shows, average investing should not be very well paid. And our goal is to be well paid. So if we think we want to be above average in pay, we have to be above average in performance. So what that means in investing is that success in investing doesn't come from being right. It comes from being more right than others, more right than the consensus. And I haven't seen many people who are consistently more right than the consensus in their macro forecasts, period. So I don't think that macro forecasts are the route to success. What I say is we never know where we're going, but we sure as hell ought to know where we are. That is to say, we should be able to understand where the market is in its cycle, what's going on around us. Again, I wrote the book, Mastering the Market Cycle. That's what it's all about, understanding where we are. And if we can tell whether securities are highly valued because of relative to history, based on PE ratio or yield spread or something like that, and if we can tell how others are behaving, again, whether they're driven by fear or greed or optimism or pessimism or risk aversion or risk tolerance, if we can get an assessment for the temperature of the market, then we can figure out how to lean in our investing. When the market is hot and everybody's excited and optimistic and buying aggressively, it's rarely the time to find bargains. Mm-hmm. We lean away. But if the market is cold and everybody's depressed and pessimistic and unwilling to buy, then it's more reasonable to think we'll find some bargains. That's when we lean in. So taking the temperature of the market facilitates our fluctuating between being optimistic or pessimistic, which we think is one of the most important decisions of all.
I wanted to talk a little bit about your writing, because you're a very clear thinker and a great writer. You've been doing for quite some time. And I actually heard in an interview that the first 10 years of your letters, there were not that many people that were reading them.
Oh, that's not accurate. There weren't any.
Okay.
In the sense that I started in 1990, and for the first 10 years, I never had a response. Not only did nobody ever say they liked them, nobody ever said they got them. Mm-hmm. So as far as I knew, I was writing them and printing them and mailing them out, and they were disappearing. Mm-hmm. So I had no response.
Yeah. And so what keeps you going for that long? Who are you writing to? Are you writing to your clients, to yourself? What is the importance of writing for you?
Well, first of all, I enjoy it. That's the main thing. Mm-hmm. For me, it's a creative outlet. And, I love to have an idea and put it onto paper and then kind of polish it into something that is coherent and persuasive. But in addition, I write for my colleagues to constantly remind them of the Oaktree culture and investment approach. And of course, I write for the clients. And even in the first 10 years when they didn't respond to me, I hoped they were getting it and reading it. So I don't remember, frankly, what kept me going, but obviously something did, and I guess it was that. I just felt that I had ideas that were worth writing, regardless of whether I had a response.
And do you think writing in general for investment professionals, do you think that's something that everyone should try to do, to put their ideas in order, or it's just a hobby of yours and you just happen to be very good at it?
Thank you for the compliment. It is a hobby of mine. On the other hand, I think it is very desirable because you can sit and think of why you should buy this or that or sell this or that. But if you have to put it in writing, and it has to be cogent and persuasive, and it has to stand up under the scrutiny of others, I think that's a great advantage. So I do think, you can't write something that's loose and illogical. The other thing is that I've been, as I've been writing over the years, I absolutely have had occasions when I wrote things that I never thought before. And the creative process of sitting at a keyboard and writing on a subject can bring on new realizations. For example, in 2006, I was writing a memo about risk. And I said in that memo, as I always said, that risk cannot be measured in advance. I believe that risk is the probability of a bad outcome, and you can talk about or think about a probability of a bad outcome. You can theorize about it, but you can't measure it. You can't measure the probability that something's going to happen tomorrow. And I've always felt that, and I continue to feel it, and so I wrote it down. And then I wrote down something that I had never thought before, which is you can't measure the risk of something even after the fact. You buy something for $100. A year later, you sell it for $200. Was it risky? You can't tell. It might have been a perfectly safe activity that was sure to double, or it might have been a very risky activity where you got lucky. You benefited from a positive outcome, whereas negative outcomes were possible but didn't materialize. So you can't even tell ex ante whether something was risky or safe. And to me, that was an important revelation, which has shaped my thinking over the last 13 years. And it popped up just from the writing process. So I'm very much in favor of it. It's not necessarily for everybody. I wouldn't say that everybody has to write in order to be a good investor. There are plenty of people who, never write, but they may have a different way of organizing their thinking.
Great. So, Howard, you've amassed quite a significant amount of wealth over the years. So what does your portfolio look like, aside from, of course, your stake at your company?
Yeah, well, most of my wealth is still in Oaktree stock. But other than that, I have a portfolio of mostly credit investments, which are designed to throw off income and produce predictable, good outcomes. And then I have turned over to my son the management of a significant amount of assets, whose job is to take more risk and produce higher returns with more aggressiveness. He's aggressive. I'm not aggressive. So that's his job. I believe in the division of labor. So, he's head of the Department of Risk Taking.
Okay. And I wanted to ask you speak about not having had mentors, but that your thinking process and your philosophy has been shaped by many great investors of the past and the present, including, you mentioned Warren Buffett, Seth Klarman, Jack Bogle.
Well, if you think about this conversation, we've talked about Charlie Ellis, we've talked about John Kenneth Galbraith. So I think that you don't have to have one person who you follow slavishly. I have gleaned elements of my philosophy in many places.
One final question that I had for you. I think your name will live on to be amongst those that we've mentioned, but I wanted to ask you, what do you want your legacy to be when people look back?
Well, of course, everybody wants to be respected for what they did and what they accomplished. I hope that people would say, number one, that I was more than an investor, but also a good father and husband and friend and good for the planet. I would love it if people would say that we demonstrated at Oaktree that you can be successful while operating on the high road. with integrity and honesty. And we think we put the clients first, and it does not impede our success. So you get to a certain stage in your life and you think about, well, how will others think about you? And I want them to say he conducted his life in the positive way.
Well, this is a great way to end. Howard, thank you very much.
Okay.
I wanted to acknowledge you for putting so much of your wisdom out there and sharing it with the world. I really appreciate it. And for everyone else who's listening, we've really only scratched the surface here, so I'd highly recommend you to go check out Howard's notes, oaktreecapital.com, under Insights, and also the books that he's published, The Most Important Thing and Mastering the Market Cycle.
Great. Thanks.
Thank you, Howard.
It was a pleasure. Take care.
Thank you. Take care.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.